Capital budgeting. Capital budgeting relates to the following concept. Let's say that your company is considering an investment in a new machine that costs $1 million. And that new machine you expect to generate additional cash flow to your company in the amounts of $250,000 in year one, $500,000 in year two, and $1 million in year three. Is this an acceptable investment for your company? In many cases, it's difficult to determine whether or not an investment like this is the right thing to do, particularly when you look at what we call uneven cash flows that occur in the years following the investment. Some companies have a very hard time trying to make these types of decisions. And what if you're trying to decide between more than one possible investment? What if there are two different types of donut machines that you're trying to compare? So one of the things that capital budgeting allows us to do is to help make decisions as to whether or not these types of investments are the right thing. When we talk about capital budgeting, generally we are talking about significant investments, things that represent relatively large sums of money to the company. So for one company, $100,000 might be a relatively significant large investment. And for another company, that same $100,000 might be a very small amount of money. So the decision as to whether or not to use capital budgeting really depends a little bit on the size of your company and the context of the money. Usually capital budgeting projects are long-term in nature, and we assume that a company has limited amounts of money and that cannot pursue every single opportunity that presents itself. So these are the assumptions that we work under with capital budgeting projects. There are three basic methods that we will discuss here. There are several others that will not be discussed here. The three basic methods for capital budgeting, or the three basic analytical processes that we use, can actually be framed with three really simple questions that we can ask about a project. Question number one, how long until I get my money back, or how long until a company gets its money back? In order to answer that question, we use something called the payback method, which will be illustrated in another unit. The next question that we could ask is, does this project generate at least some specific percentage return? For example, your company might decide that it has to earn at least 15% return on a project or it will not do it. So you would frame the question, does this project generate at least a 15% return, yes or no? That's what we call the net present value method. If you want to know exactly what the percent return on the project was, then you would solve for something called the internal rate of return, or the IRR. So these are three basic questions that we can ask that relate to three specific, very, very fundamental capital budgeting methodologies. Usually after running a capital budgeting analysis, if we're looking at more than one project, generally what we do is we rank the projects in order from best to worst. So a project that had, for example, the highest net present value would be at the top of the list, and then down in descending order to the project that had the lowest or worst net present value. And then a company can look at that list and say, okay, here's how the projects rank against each other. Now, which one shall we select? And it just gives us a framework for making decisions. Capital budgeting methods do not always give us the correct answer, because there may be other factors besides the financial analysis of the project. There might be strategic reasons for making an investment, for example. However, these provide a financial framework within which to begin the discussion in a rational way. And in many, many cases, projects that seem otherwise to be very, very good fall apart once we apply capital budgeting methodologies to them, because they don't generate returns to the company. So it's a very important thing to do, and these are the three most fundamental methods that we will look at: payback, net present value, and internal rate of return.